Welcome to M&A Science, where leading M&A practitioners share lessons learned from their experience. If you're interested in keeping up with the latest from M&A Science, visit mascience.com and subscribe to our free newsletter. Every week, we share highlights from our interviews and invitations to events as we build the greatest community of forward-thinking M&A practitioners. Again, that's mascience.com. I'm your host, Kison Patel, CEO and founder of M&A Science. Joining me today is Barak Routhenstein, Vice President, Corporate Development at Profile Products. Profile Products is a provider of sustainable soil health solutions to promote vegetation in horticulture and environmental solutions. It's a portfolio company of New Mountain Capital. Today, we're going to talk about acquisitions through the lens of corporate development and high growth private equity. Brock, how are you doing today?
I'm doing well, Kison. Thanks for having me. Happy Friday.
Happy Friday. Thanks for taking a break from doing deals to have this conversation. Can we kick things off with a little bit about your background?
Yeah, sure. I've spent most of my career doing buy-side M&A, and from different sides of the spectrum. I started my career actually before I got into M&A on the buy side. I internship at a law firm doing transactions from the legal side, which I learned I didn't like from that point, and I tried to transition into the finance side, where I worked at a family office PE firm that focused in healthcare. Was there for about 2.5 years, had a really great experience buying and building companies. From there, I transitioned to a publicly traded strategic. We were doing 20 to 25 deals per year, an M&A machine, a lot of growth, a lot of deals, and a lot of great responsibilities there. From there, transitioned to a private equity-backed business in the biotech space that we sold to another private equity firm. Stayed on there for a few months before I was recruited for my current job, working with Profile Products, which is backed by New Mountain Capital. And it's been the past few years have been exclusively focused on growing high growth PE-backed businesses, developing M&A strategies, executing, and then integrating businesses.
A pretty diverse background on the buy side, kind of going from private to public to private equity. How have you seen acquisitions change over time?
I don't know that I've seen acquisitions themselves change over time, but I have seen the differences in what matters to family-owned private equity firms, publicly traded companies, and what has to get reported to the market. And just a high-growth PE firm that all they want is acquiring businesses versus ones that might be a little bit more strategic in what they acquire, when they acquire, and when they take time off from acquiring and integrating businesses. And seeing the use of capital, depending on the capital needs of the business, has been fascinating. But over the past decade, I don't know that I've seen differences in actual M&A, but I have seen, based on where the money comes from, the strategy changes.
How about more specifically with private equity acquisitions these days?
Yeah. So, I mean, today what I'm seeing pretty regularly is, I guess it depends on the size of the fund and the size of the business itself, but some are just buy. Just buy, we'll figure out integration, or we won't figure it out integration. And that's okay. And businesses are operated independently. As long as it fits a paycheck that either the business can write, or they can debt finance, or they can, infuse more equity into the actual business, then buy it if there is some relatability to the business. But I've also seen well, let's make sure that the strategy makes sense. Let's not overcapitalize the business. Let's make sure that we're not breaching any lending facilities, because we want to make sure that the long-term growth on an exit will create more value than just bolting on businesses. And what I've seen on that side is the integration is highly valued compared to where it has been at just bolt on companies and buy them and we'll figure it out later. And the integration and hiring integration specialists and bringing them on during the diligence process to help integrate a business on a post-close basis. To me, it creates more value. I like doing deals that create value, not just for the investors, but for the actual business and the customers and the stakeholders of the business on the down the road side. And leveraging the integration specialists, to me, I've seen a lot more value on the back end.
So would you say there's generally a greater emphasis on ability to integrate the companies and capture those synergies from the integration?
I've seen publicly traded companies operate like private equity firms too, where you buy businesses and they're kind of bolt-ons. They're loosely integrated, maybe financial systems, maybe HR systems, but that's kind of it. But I've seen buyers walk away from private equity processes because companies aren't integrated enough, and they don't want to spend the time and the money to integrate a business into its own entity because it's not integrated. It operates like 10 or 12 separate companies owned by one parent company, which is it's a different target when you're on an exit. So one of the questions that we like to ask internally is, what do we want to sell our business as down the road, and how can we integrate our business now to get there in 3, 4, 5 years from now? And I don't know that everyone's asking that question, but we're talking about it every time we have a deal on the plate.
Yeah, that's a very interesting point there. Wouldn't that be an opportunity of its own to buy a business like that that isn't that integrated all together, get some cost synergies, maybe figure out revenue synergies?
I think so. Yeah. I don't know that you'll see if that's your sole investment thesis. I don't know that you'll get the return that you want. But what you probably will see is that you will have faster growth on your bottom line because you can cross sell better. You can have synergies on your suppliers, and you'll actually see the increase in margins because of that across the board. So whether that's your sole investment thesis, I don't know that I invest in that, but I think it's important for businesses on a long term sustainability run.
Maybe you got integration figured out. That is your differentiator.
I am not the master of integrations, but I am one of the drivers. We make sure to bring on experts in the space because we know that their expertise in systems and how systems talk and how companies work together as feeling and working like one company instead of just saying we're one company. And there's a feeling to it, not just a technical can IT system from company X talk to company Y. It's, do the people actually know each other? Do they work together? Are they calling each other when they have a question? When there's a, hey, I'm at customer Y's office right now, and I think there might be an opportunity. You have 5 minutes to just talk to them on the phone, and not having those connections on a personal level, you lose opportunity. So building that has been interesting.
How is that with the overall go to market when you start looking at deals and thinking about how they're going to be integrated?
It's important. There are different levels of the strategy that you assess when you look at an acquisition. And to me, one of them is, how are we going to approach a customer? Are we occupying more share of wallet at the same customers we're talking to? Or is this so adjacent that we won't be able to cross sell and we're just entering a new market, which might be the play depending on the size of the deal. But you can't really roll up businesses in a completely new field unless you're buying and starting a whole new vertical that's going to be targeting a whole new customer base. So for me, I like to make sure that we understand what we're getting into, whether it's a $15 million revenue business or a $100 million revenue business. What are we buying, and how is it going to work with our current business today? And how are we going to work to grow it down the road? Because our resources are focused on growing our core. Is this part of our core, or is this so adjacent to our core that we're going to have two cores? And then you have to have a whole new thesis behind why you're buying it.
How early are you thinking about that?
Probably from the first call with the management team. I want to have a high level understanding of how this would fit with our business before I can bring it up the chain. Yeah, I don't find value in coming to our CFO and C-suite and CEO and talk to them about a business that is so adjacent, it's just buying another business. I want to know that my thesis has cross-selling opportunity, has supply chain synergies, has some sort of management leverage or new product that can we can cross sell to our current customers. I want to make sure that I have at least a high level thesis. Whether the technical parts work out, that's for our experts to determine down the road. But I want to have that thesis when I pitch it internally before we start spending more time on it.
How much ownership do you take over that in your various roles versus you have a business unit leader that's driving a lot of that strategy and view on this acquisition?
So I'll go with a lot. I like to get C-level buy-in before we spend business unit leadership time, because I'll rephrase, business unit leadership um, has a lot of commercial activities that if it doesn't fit strategically at a C-suite and potential board level, then I don't want to waste people time on it. I want to get that check mark before I approach someone and start spending time. Because to me, the next call would be, great, let's get the business unit leader on the phone with this guy and have our C-level people in there too. We'll do an hour, learn more about these companies, dive in, and want to make sure that people's time is used wisely. So I try to own all of that initial work before spreading it, unless they brought me the opportunity. If they're
I
the
was
one
gonna say,
who brought me the opportunity, then I already have their buy-in at that point, and then it's just running it up the chain.
where do you typically see most of your deals coming from, up the chain or through your function?
It's split, and I think it depends on PE involvement and the history of the business and M&A in general. Um, how do I go back? So years ago, we were sourcing our own transactions, jumping to publicly traded company where people are in the business for 15, 20, 30 years. They have relationships with competitors. They know they market. They already have regular touch points, and you're just jumping into an existing relationship. If you're building a function that doesn't have a background in it, which not all of these PE-backed businesses do, you're kind of starting from scratch. And the scratch isn't no relationships. The scratch is you leveraging the relationships that you don't know exist yet to have the calls that can get you a pipeline to source you a transaction, and training folks and building muscle memory that, okay, this is what we're looking for. Help me learn about this market, who your competitors are when you walk into a customer. Are any of them interested enough that there might be a unique fit, whether it's having more tools in our bag to sell to the same customer, or a competing product, or getting rid of a competitor, whatever the strategy is. Um, um, Building that muscle memory is important. So I've seen it across the board on how you build the pipeline. I try to get my hands in the weeds no matter what, because that helps me learn the business more and helps me have a better conversation with a target, with a customer, management, and the board.
What's the appetite been like on international deals? Have you seen those increase, decrease?
We've just closed a couple in the past year. We bought a company in India and a company in the Netherlands. My first time buying a company in India, and it was very complicated. Very
I can
complicated.
imagine. You don't have to hold back because I'm Indian. You can say it's
No,
painful, pain in the
no.
ass to deal with us.
There were local regulations that we didn't think about that just made it drag out. Like opening a bank account took like 3 months. Like it was some painful things to do. And we needed to open a bank account so we could transfer funds to our entity to actually be the acquirer. Like it was small things that just dragged on the deal for a lot longer than I want. Whereas if you have an existing entity in India and a bank account, like things get wrapped up a little bit quicker. So there were some things that were really painful. But I went to India for 10 days, and it was one of the best trips of my life. It was awesome. I had a great time. Beautiful country. I saw the south and the north. So to get back, I think it depends on what the business needs. I can, I know a lot of people are avoiding the Baltics right now just out of pure, fear and unknown. But other parts of Western Europe and other parts of Asia, Asia Pacific, Australia, I think people are hungry for deals right now.
Still strong appetite for international deals. How about in terms of actual strategies at play? Are PE firms still mostly executing roll-ups?
I think there are two different strategies. One is the roll up increases your core competency. If you can strengthen your core by rolling up competitors in the space, by rolling up complementary products that fit into your core, then I think roll ups are a great way to go. More share of wallet with your same customer base, maybe getting you into an adjacent space just because the products that you're already selling are applicable, but you didn't know about the market, or you're learning more about the market and you're learning more about the applicability, gives you more cross-selling opportunity. But there's also the horizontal move into creating a new vertical. And to me, that always depends on the size of the deal. I don't know that I want to spend, I'll give you an example, right? If your EBITDA is 50 million of the business that you're working for, and you're buying a $4 million, horizontal business, which would give you new vertical. To me, I don't think that would really make sense and be worth your time because it's not big enough of a bite to chew to make a material impact on the business. But if you're in the double digits at that point and you're looking at a 10 or 12 or $20 million EBITDA business, that could create a new vertical, arguably, to me, and that creates a whole new level of value, if depending on the end market and the customers. But both to me are important at this stage.
Can you walk me through how a private equity firm looks at acquisitions?
There are a few different parts that are important to them, right? You have your economic and financial variables, making sure that the business is healthy and growing, and the EBITDA margins aren't decreasing the value of the portfolio company. Having something that's either growing quicker, equivalent or higher margin, or a plan to get to higher margin post-close with synergies is increasingly important. Buyers at the end of the day, when PE goes to sell, want to pay for growth and adaptability, and knowing that they have a business that's going to continue to grow, which is how you're going to get your multiple. So not depleting your margins at the end of the day is important. Obviously, strategic fit. How do the businesses fit together? What's the story that you're going to tell? What's the story now? Does it actually make sense on why this business is important to buy, or why this space is important to go into for the portfolio company? And then you have your cultural HR kind of reasons. And I use that kind of broadly, making sure that there's cultural fit, because if you don't have cultural fit, at the end of the day, companies aren't going to work together well. And I've seen deals blow up and not get across the line purely because of cultural reasons. And I've seen deals post-close blow up because of cultural reasons. And I don't know that people are always taking it and giving the consideration that it needs. Sometimes you do a deal because you want to just get a deal done. But unless you're looking to change management and kind of wipe the slate clean, having the cultural fit's important.
Have you ever walked away from a deal from bad culture fit?
Yeah.
What'd that look like? You don't have to name the company.
Oh, I wasn't planning on it. It was messy. It was messy. You spend a lot of time essentially dating this company, getting to know them. And if you're post LOI or pre LOI, it's different. The relationship's
Right.
different. The level of, going under the hood is different. So post LOI, it can get really messy. There's a lot, there could be views of breach of trust down the road, depending on how you relay the message. Obviously, you don't want to say, I don't see a cultural fit between us. I don't think this is going to work out. But being honest is important too. Earlier, it's an easier conversation, to have. It's easier to break off a relationship at that point. But further down the road, it can get messy.
Um,
I've seen personal lives of people kill up deals too. So we had a deal a few years ago where we were, doing a background check on one of the business owners, and it turned out he had a criminal record that we didn't know about. And granted, it was like 15, 20 years ago, but it got people a little anxious and fearful about doing the deal. And there was a different personal issue of the guy that blew up the deal. But the personal lives, to me, have been something to actually get to know a little bit more since that happened, because they have a high impact on the deal if someone's going through a divorce and they don't want to split proceeds with a current wife, soon to be ex-wife. It can blow up a deal. So getting to know a founder or a CEO or management or whatever is needed to make that final decision to close is important on the cultural level.
what do you do to do that besides take them out for drinks?
Spend time with them. It's like developing any relationship. Spend time with them, as much time as you can. I mean, go to their facility, spend a week, and call them every day. It takes
Long
time.
walks around the building, long
Yeah,
walks in the park. I don't know.
yeah, walks in the park, meals, dinners, get to know spouses, um, get to see them in their element.
Do you walk from a deal from bad culture fit post LOI?
Yeah.
That's where I feel like would be tough because you probably spend money in diligence. You're invested in. What'd that look like?
The hard part about that conversation isn't just how do you relay it to the target, but it's how do you relay up the board that I just don't trust this guy, or I'm not getting a good feeling from walking around the facility and seeing the interaction with employees. Like there's something that just kind of stings my gut, because a lot of it is a gut feeling. A lot of it is hard to measure with metrics, unless you have like a really high turnover ratio or something that's indicative of a cultural issue. Um, but seeing it and smelling it and tasting it, I mean that it's a hard conversation to have. It's hard to relate to a CEO who's really excited about a deal, and it's like, and if it's in my opinion that it doesn't make sense after that kind of assessment. I mean, I try to encourage the CEO, getting to know them on that kind of level too, not encouraging the negative, but encouraging the relationship. And forming a relationship is important, because on a post-close basis, depending on reporting structure, you're going to need to have that kind of interaction. So it's hard. It's hard on all levels.
You as a corporate development leader and your relationship with private equity firms. I think this is interesting because you've gone through this. You've gone through multiple owners and PE firms, different portcos of different funds. What does that relationship look like? How does it vary?
It varies highly. I'd say in general, it's felt supportive, but depending on the trust from the private equity firm to the actual portfolio company, there can be a lot of distance in between conversations. There can be a lot of distance in terms of help. So I've seen, highly supportive weekly or biweekly, like twice a week or every other week calls, down to monthly or even less, depending on the M&A environment and the environment for of trust in general. To me, the way that I've seen the relationship and how I've enjoyed the relationship is frequent touch bases. I think it's hard to have connection without it. Even if it's for 15 minutes every week just to catch up on things that are moving. I found that to be the most supportive environment versus the, okay, M&A is a little slow, or we trust you, just let us know when you have something M&A to talk about. Because M&A, everyone wants to know what's going on at the board level, M&A wise. So having frequent touch points helps create more trust, helps create more transparency, helps, floating ideas of a, hey, I'm looking at this. Do you guys want me actually spending time here? It was floated across my desk. Just want to make sure that we're using our resources according to what the board wants us to do. And so the more frequent the touch point, to me, the better.
I'm just curious, like, what are the extremes you see from, is that basically the fundamental, very low amount of communication versus high amount of communication? I want to get a sense of, give me a profile of what the ideal PE sponsor relationship looks like and what the not so ideal PE sponsor looks like. Because there's got to be more than just communication. Is it
Yeah.
over critiquing every single deal that you're looking at? Is it being too conservative for you to get out there and be competitive in the market?
I think there's a balance, like for any relationship, right? Their job is to maximize shareholder value in the long run to make sure that they can get a good exit. And my job is to make sure that management's working together to build a company at the vision and thesis of the private equity firm. So making sure that all hands are aligned whenever we do something is important. So to me, the best cadence is either weekly or every other week, touch points with formalized meetings and agendas to walk through everything that's live, on the table, and pipeline down the road. Making sure that we're aligned on strategy, make sure we're aligned on execution, make sure we're aligned as things are getting more real, that we have the right resources involved, and the approvals that we need to have the conversations that we need internally and with targets and stakeholders, and third parties. What I find valuable is that when things get overwhelming, private equity understands M&A, right? My job is to be an extension of them, essentially. They want to buy more portfolio companies, and they want to trust Corp Dev with growing their PortCo with M&A. But when things get kind of wild on the PortCo side, they go, okay, you got too many live deals. Let us jump in and help you with that. And to me, that's been helpful. We actually had that in Q3 of last year, where there were just too many live deals, and they jumped in and they helped get a couple across the line, and it was incredibly helpful. They didn't even ask. They're like, "Listen, we're jumping in. We can see that you're drowning here. Let us help you." So having that kind of relationship of we're here to help is important.
Where did the conflicts happen in that relationship?
I mean, I've had deals that we've really rallied for as a company and as a leadership team that private equity did not want to support and didn't support, but wanted to give us the motivation and encouragement that they will support us doing deals. So it gave us the leniency to chase. And I think being an advocate, but being realistic and creating boundaries is important. So if you don't want people poking their head in this adjacent space, let us know so we don't spend time on it. And by us, I mean whatever the PortCo is. I've sourced transactions before that turn into new PortCos for the private equity firm. Whether that's helpful or not, probably, right? We're making the introductions, we're giving them the download of an interesting opportunity. But staying out of this sector or this industry, the earlier that they can let us know is always best.
How about the approval process? How do you see that vary from PE owner to PE owner?
I've seen it as highly formalized, where they want really highly sought after pitch decks that kind of break down every level to just put together a one pager, and we can move forward at least with an LOI to at a strategic level. I mean, they're looking for a higher level of diligence because of the cash is all coming to the bottom line. Your net income per share is what's going to be relayed, not just your EBITDA. So, but on the private equity side, kind of anything is game depending on what they want to spend time on. So learning that kind of upfront is important. How formal it is, how much detail they want in initial phases, and what they want to learn down the road. Everyone kind of has their standard diligence items that they're looking to track upfront and progression throughout the close of the deal. And they're all close. Some value some items more than others. So having clarity around what's valued and why is important. But they all want different things.
I wanted to talk about sourcing, and I think there's a few lens of how private equity looks at how they look at sourcing platform opportunities versus how they look at supporting, helping the portfolio company identify opportunities. Um, could we talk through that and maybe even how it differentiates from the corp dev's role and how they look for opportunities versus how the private equity firm may help them do that?
From what I've seen, there's a higher reliance on banker relationships for acquiring portfolio companies, whereas it's only the smaller investment banks that'll represent what a typical PortCo would acquire. If you're not a multi-billion-dollar, PortCo, and you're in the middle market, a few hundred million of revenue range, you're looking at only a few investment banks that'll represent the tens of millions of revenue kind of businesses to get deals done. So you're more reliant on, at least on the corporate development side, relationships. It's a lot of relationships with owners, longevity in an actual business, trade show, who's putting up a booth, and getting to know people on that kind of level versus going out to meet investment bankers at different networking events like JP Morgan.
How's the support from the PE firm? Like, is that a big driver for them identifying opportunities, or does that still fall back on your lap? It's a mix. I don't know.
It's a mix.
Varies by PE owner.
It's a mix. If they're bringing in a corp dev person, they want acquisitions, and in order to do acquisitions, they need a pipeline.
You got to
So
do your job.
yeah, got to show my value. Got to show that I can get stuff done. But I think it depends on what they're looking to do, right? Each private equity firm has their own resources, and each one will give you access to what they're comfortable giving you access to. And by you, I mean the corp dev guy or girl. There are a lot of great resources out there that I'm sure you've seen. that helping diligence companies or markets or getting details on companies to kind of narrow down opportunities is helpful. But also building kind of a resource bank of internal experts, which could be on the board, it could be third parties that they trust, it could be whatever they're comfortable with. I've worked with private equity firms that don't want to spend money on third parties. They don't want to pay banker fees. They don't want us paying banker fees. So we can't reach out to third parties to help us source deals. And I've worked with ones where a deal's a deal, and that's a one-time fee. So let's get a pipeline built. And depending on what the appetite is, those are it's communication in the day, but understanding what the boundaries are that I can work within and Corp Dev can work within.
It sounds like if they're willing to provide resources to help source, you'd probably want to leverage it.
Yeah, I can say that we've had a lot of resources at New Mountain Capital. Building that pipeline is important. I mean, I started here about a year ago, and I mean, it hasn't stopped. The trajectory, the pipeline building, the sourcing, there's a lot of activity going on because we're spending time building relationships, getting to know companies, exploring new industries and adjacencies that help build our share of wallet for customers. And it creates opportunity down the road. Whether we want to do a deal now or in a month from now, we have opportunities because we're spending the time and energy building a pipeline.
How does that support continue from sourcing into diligence and integration?
I think it depends on the preferences of the private equity firm. Some of them like being involved in managing third-party advisors, whether it's their relationship or the company's relationship. Some of them like to be involved. They want to be involved with, your financial advisor, your tax advisor, even your legal advisor. And I think depending on what they're looking to be a part of, whether they want to manage the relationship or just have the option to join a call that's happening, or just see the diligence output down the road, it's all going to be different based on the level of need of that firm and the reporting structure within.
Tell me more about reporting structure. I could see that varying as well. So what is the expectations range from how you report back to the PE firm?
I've always had regular touch points with the PE firm and regular touch points with the C-suite at the PortCo. I'm an employee of the PortCo. I have a reporting structure, a formalized reporting structure, currently up to the CFO. In past lives, it was up to a CEO. And I phrase it as a dotted line to PE, where I weekly calls with the private equity firm as just a catch up on how things are going. But anytime I have a question, pick up a phone and call them. Having that open line as needed is helpful, but it's not formal. It's more of an informal dotted line reporting line to them.
I think there's two things to segment. Here's stuff that gets rolled up, and then the C-suite has their own communication reporting responsibility. But then specific to M&A activity, obviously is the pipeline reviews, right? But then beyond that, what other things would you be reporting back to the PE firm?
From what I've experienced, a lot of regular touch points between the C-suite at the PortCo and the board or the private equity firm. There's always interest in live transactions. So whenever there's something live, making sure that those to whom I report have the knowledge to relay the correct messaging and next steps and where we are with various levels of activity is important. And keeping the PE firm on my own terms with on a line call or one-offs, making sure that they have the knowledge is important. But I mean, my job is to report everything up the chain to our C-level to give them the tools that they need to report to the private equity firm. And at the same time, I mean, I have a dotted line to the PE firm as well. There's no formal reporting structure, but we get on the phone once a week, catch up, make sure that if I have any questions or they have any questions, because they're reporting up to at the PE firm as well. And they're going to get asked by their superiors how the M&A is going on at X PortCo, and making sure that they have the knowledge that they need can report up as well. So there are two kind of levels there. One is more informal and one is more formal. but not just, pipeline and but I guess pipeline live transactions. And then how are the integrating businesses or integrated businesses performing on a post-close basis, and giving them the weekly or biweekly or monthly knowledge that they need to report up their chain, so they can have this business in India is doing great. It's up year over year, month over month, and we're glad we did the deal, or it's not, and here's what we're doing to fix it.
What's advice for private equity firms to best support corporate development in their portcos? And I feel like I see so many that are in the early stages of it, where they're just shaping corporate development as a function in their portcos, and then just see a lot of them at that stage. So it's new for the company, and some of those PE firms that aren't in the top 50 list, it's relatively new as well.
My advice would be, just like getting any other deal done, more frequent communication is better. Um, Whatever the relationship is, the more frequent the communication, the better, at least, especially in the early ages, when you're trying to build the function and create the boundaries around how the function will operate, how it will report, what you want it to report, how it'll actually conduct M&A. Because I've seen times where the PE employees feel like they're being overruled by the corp dev folks. And I've seen relationships kind of, build or need to build a bridge, to try to fix and repair some hurt ego on both sides before. So the frequent communication and the understanding of working together to building kind of a team, to know that you're going to tackle deals together, and that corp dev is going to handle this and PE is going to handle this, and how we're going to work together when we get to deals. And if we have one deal, it's going to change for if we have 5 or 10 deals. But having the relationship, and having the frequent communication is important.
You ever felt overly policed by a private equity owner?
No, overly policed. I don't think so. I have felt that sometimes the amount to report might be overwhelming depending on what's going on. And but I've also seen PE firms say, listen, we know you have a lot going on. You don't have to report all of this stuff. Just tell us about X, Y, Z. And again, it's having the open relationship to raise your hand and say, I got too much going on right now. I need to skip this meeting, or can I give you a shorter brief on what's going on, or how can we, or can you help me with something? Because there just isn't enough time in the day to get stuff done. Again, it all kind of focuses on that relationship that you build with PE, because then they're important here.
I was going to flip that advice around for that first time corporate development leader that is under a portfolio company or PE firm. Advice for that person to make things work and have a good relationship with the PE firm.
Be open, be honest, be vulnerable. I mean, you're going to be thrown into new things, and raise your hand if you want advice. And one of the early pieces of information that I had with, I would have one-on-ones with one of the partners at one of the private equity firms, and asking for help on sourcing and pipeline development. I didn't realize that they go through, at least in the PE side, they have to source their own deals too. And they're measured based on their deal flow and their pipeline development skills, and being able to generate a pipeline, not just company performance and exit value and return on investment, but actually being able to bring deals to the table. So there's a lot of similarity, and asking for help, leveraging the knowledge that they have. Don't be shy to ask for help.
I like that. Ask for help, learn their process, because you can probably learn some things from them.
Yeah.
So much of this has been around communication and relationships. Let's break that down some more. Give me some tips and tricks around it. Obviously, you're a nice guy, Brock. Give me time over here. So maybe there starts off with some fundamentals there, but are there ways you stage meetings to make them productive? Any little more tactical things they can teach me?
Yeah. Again, it all comes down to being open and vulnerable and transparent, and whether it's upfront in the interview process or after you've been hired because you weren't sure how to go up on a touchy subject. But be honest, say, listen, like, my level of working with this skill set is this. How can I leverage you guys to help me get better and improve my skill set? Can we do weekly calls for 30 minutes? Can we do bi-weekly calls? Can I work with your team member on leveraging these resources or that resources? What resources do you have for me to leverage? How can I work with you guys to help me do my job better? And they'll tell you. They'll tell you what the opportunities are. They'll tell you if they want to give you time. They'll tell you if they don't have time for you. And asking for what you need, which I found is useful in all aspects of my life, not just work. It is going to help leverage that relationship and give you the tools to succeed in your corp dev role.
Well, what does the reporting structure look like internally for you when it comes to M&A activity?
I report directly to the CFO with a dotted line to the CEO. And it's a dotted line because I'm not a formal report, but everything needs CEO sign off, not just business unit leader sign off before it goes to the board. So for me, I like to make sure that they both learn about M&A opportunities at the same time. I'm bringing it to their attention, whether it's an email or a phone call or hey, do you have 15 minutes to jump on a Teams meeting? We had this interesting call, and then creating a more formal meeting with actual business unit leaders. But corp dev, our job is to support the growth of the entity, making strategic decisions, helping analyze opportunities, getting company alignment, and then presenting it to the board where we think it makes, in my opinion, cultural, economic, and strategic fit, and making sure that you have a good relationship for me with our C-level, our executive team, for why deals make sense. I'm in full support on, yes, this deal makes sense. We like the people who run it today. We can work with them, and we can really blow this market up with these resources. Again, it's the story. It's everything working together is important. And when you have that kind of that feeling of this is a superpower to have, we buy this, it's a home run every time.
Are there key little elements within that really clinches the win in terms of the nailing that story down or having specific points around how it aligns with the strategy or the finances? Like what are those real golden nuggets that you think are the key to pitching a deal?
I think there are a few different parts to it. I'd work with the team on who relays the strategic message for why a deal makes sense. Knowing your audience, which is the board or the PE firm or your M&A team or whatever you call them, and knowing who internally can relay the why for why the strategy makes sense. It's not always the CEO, it's not always Corp Dev, but it's from my experience, it can be the specialist in the field, whether it's the business unit leader or the head of sales or whatever the commercial arrangement is. It's finding the right person for that opportunity who can really tell the story for why a deal makes sense, and leveraging their expertise for that part of the pitch. The rest of it is just data, right? You lay out their financials, you lay out your thesis, you lay out how you would roll it up or share resources or synergize. That's all like you read and you have follow-up questions, but the story itself is important because it's going to change the shape of the future of the business, and making sure that you have the right pitch and the right pitch person can change the trajectory early up front.
Oh, where does private equity draw the line? Because I feel like at some point they're like, all right, you're on your own. And from what I'm seeing or have heard, it tends to be around actual post-close integration activities. Is there any level of support? Do they give you a list of consulting firms you should go hire? What does that look like?
I've seen it differ at different private equity firms. Some of them like to know that you can cross sell or your financial systems are talking, and some of them want you to get a third party advisor involved, and some of them want to hire a resource to dedicate to integrations. I think it depends on what the goal and the thesis of the private equity firm is. I spoke with a private equity firm a couple of days ago, and they didn't integrate businesses at all once they acquired them. they would do deals to build up the PortCo and then sell it. And the next buyer would focus on integrating potentially and acquiring new entities. And I depending on what the goals of the next exit are, I think the levels of integration differ. And I mean, the different levels of private equity, based on their experience, they understand this, and you'll see it depending on what they do with their current PortCos, asking about an interview process about how they integrate, what kind of integration they're looking for, and what they're looking for on exit, and kind of in general. We'll give you that kind of view about what they're trying to do with the business. And but to me, I find integration to be highly time consuming and incredibly value creative if it's done well. So the time is worth it if you can do it well.
You think there's like a maturity curve for that private equity firm and how they view that approach?
Probably, but
Early
it's
on,
also
they're like,
resources. I think it's all resources, right? Their primary job is to spend that fund to make sure that they can get the returns for their investors. And I mean, some of them just focus on that, spending the fund. They're smaller, less resources. They don't have levels of associates and analysts that can dive in and work with companies on how they're integrating and why and what the outputs are going to be. And some of them kind of don't care, from what I've seen. They just want to know that you can cross sell and you can, roll in the financials and put together a package on an exit. So I think there is some sort of maturity curve.
right, and you're right, size has a factor because if you're working a bigger fund, you can set up an operating group to support portcos in a very different way than a smaller fund.
You also know when to pause certain, capital activities to focus on integrations. This has been a heavy year. Like let's take off 6 months, make sure we integrate, make sure that we can go to market as one entity, not as 2 or 5 entities approaching the same market. Let's spend time focusing on that. And again, I think this level of sophistication, which comes down to typically size and where they spend their own time.
What's your approach with relationships with the target company look like?
My relationship with the target company, I try to build it so that we create a personal relationship um, depending on kind of nothing, right? I want to make sure that I get to know the people who own the business or the CEO if it's not the owner, because deals don't always happen now. And having someone that I can call in 3 months or in 6 months or in a year from now or send them an email and know that they'll respond or pick up the call or respond to my text. To me, there's more value in building that relationship for a no specific time period versus I'm coming in because I purely want to buy your business. I really want to buy your business, but I want to get to know you as a person, and getting to know them as a person. It helps kind of check that cultural box to see the fit, but it also helps you reach out when there might be better timing. People don't always want to sell their company, from what I've seen, to someone just because they have a checkbook. They want to make sure that their legacy is going to be continued down the road, that their employees that they've had for the past 15 or 30 years are going to be kept. They want to know that they trust and they want to work with the people that they're going to be getting in bed with, because this is a lot of these folks, it's their legacy that you're buying. So having the trust in the relationship, to me, goes a long way.
Do you find a variance in terms of how collaborative people are on the other end, and how do you get around it or do things to enable better collaboration?
I'll give you a couple examples. I bought a business from a founder a few years ago. The guy had started the business in the 60s. He sold to me in, I don't know, 19 or 20. And I mean, the guy had run it himself. He had a couple of lieutenants, and his plan was to walk away after he sold it. And by the end of it, he was sending my kids gifts in the mail. So we built this level of connection that was, whatever you need, just let me know. I'll do it for you. But I've also worked with targets where this is the information that we're going to give you. that we're willing to share. And that's all you're going to get. And to me, that shows a level of cultural fit, because when I want to spend not just money, but time for myself, my colleagues, and my team to learn about and dive into a business, we want to make sure that on a post-close basis, we're going to like working together. And to me, that's kind of a red flag, cultural fit wise, that they're not going to let us fully under the hood. They're only going to lift apart, whether they're hiding things, or not enough trust, or we just don't want to show you stuff because we don't want to do the work. I mean, to me, those are all just, yeah, I don't know if this is going to work, kind of red flags. So the better the connection, the easier it obviously is to get done. But when you're working directly with the founder or CEO or family that's selling the business, the better the relationship, typically the better the outcome.
What happens when you don't grow your company to the ideal targets of the PE firm for their holding period?
I think there are a couple different outcomes. One is they hold it longer until you are growing it to meet the metrics, or they could sell it at a lower multiple and just try to get out. I can tell you from the PortCo side, when we've acquired businesses that haven't performed according to our initial estimates, or even our pre-close estimates with an updated budget and performance, and it's all about, okay, fine, what are we going to do now? And coming back with a plan for how we're going to turn things around. It might not be in 6 months, but it's probably going to be in the next year or two. What's going to change in the market? Why is it going to change? How are we going to do different? What resources are we going to allocate? How are we going to cross sell or market differently? Coming up with a full plan for this new business is important.
Do you see PE firms buy other PE firms?
I've seen PE firms make investments in funds of PE firms. I remember seeing a couple of years ago that a smaller PE firm was bought out by a larger PE firm, and they just bought the whole portfolio. I don't know enough about that to really comment on it. I think you're entering in a whole new level of risk when you buy a portfolio of businesses. It's kind of fascinating though, right? If you're a mega fund and you just have, 10 billion that you need to spend, so you just buy a middle market PE fund that's got, 5 billion under management. That's a unique return potentially. Buy them all at once, see what happens. It changes a lot of relationship dynamics, which you don't know how portcos are going to react. You don't know how your investors are going to react. So I can foresee a lot of challenges there. But I can tell you from my what I've experienced is that sometimes mega funds will invest in funds of middle market PE firms, as a way to diversify. And that's kind of interesting, depending on the relationship and the access to opportunities. You may have reach into pockets of other private equity firms and their resources, and lots of potential leverage.
Yeah, I know I'm drifting off topic. I just was curious, how come we don't hear too much M&A news within the M&A PE space itself? But hey, before we wrap things up, Brock, can I ask you what's the craziest thing you've seen in M&A?
I was looking at a business in Eastern Europe a couple of years ago, and I remember the initial conversations. There was a historical relationship, CEO to CEO, and it wasn't their first conversation. But I remember hearing this guy he had a really interesting business, not making a lot of money, say low millions, but a really high, $100 million plus purchase price that he was wanted for the business. And I mean, it was sky high. There's no way we can get there. We give him an offer, and we're like, before we give you the offer, we don't want to insult you, so we're just going to tell you about it while we're looking on the phone. And if you don't want it, we get it. Maybe as the business grows, we'll talk about it down the road. I've seen that guy actually achieve his exit value, because instead of going PE, he went strategic. And the leverage of the resources and the synergies between PE and strategic, I mean, there's a different share of wallet. There's a different pocket opportunity for who can write larger checks. That to me was fascinating. That a valuation could be achieved, which to me didn't make any sense in any world. except for this one. So I think when people, a lot of times you talk with company owners and they would say, well, my company, I think it's worth X million. And I'm like, well, it's not worth X million to me, but if you find the right buyer, they might be willing to pay X million. But if you want to work with us, like this is what we're willing to pay. And understanding that deals are all different. I mean, you come up with your own valuation based on whatever metrics you want to. But at the same time, there are a lot more that goes into it than just the numbers.
That's a good point. And then that perception of value is all beholden to the buyer.
Yeah.
Yeah, that is interesting. It is interesting how people drive value in some of these deals too, because it just makes less and less sense as the years go by. Well,
Yeah.
this has been great. I appreciate taking time to have this conversation and teach me a few things about operating as a corp dev leader within the PE environment.
Thanks, Kison. It's been a great conversation. Thank you for having me. Really enjoyed the time.
Hey, you're helping me become a better M&A scientist. So those of you still with us, hope you are as well. Until next time, here's to the deal.